it's an amazing set of people on the stage here, and thanks, Rajesh, for joining us online. This panel is actually very close to my heart personally because, these are the people who actually support us as LPs or help us, like Rajesh, for example, helps us connect with the HNIs and family offices. And, so basically, this is a panel which actually will cover the other side of the funding in terms of how the collaboration works between the LPs and GPs and how engagement works between LPs and GPs. And we're very fortunate to have a very diverse set of people here representing banks, insurance companies, and also bringing the perspective of the family offices. So thank you so much again for joining us today. I will, basically start asking one question to all of you. And this question is more about how has been your experience, and I think some of you or most of you have been seeing this venture capital space over time in India. So I would love to hear your views in terms of how you've seen this venture capital space evolving in India. So I would love to maybe start with Prasun, you, and then we can follow after that.
Yeah, thanks, Vikram. So our experience over the last, say, 5 years of investing in the space has given us some perspective on where this investment class really works for us. So far the experience is restricted to putting the money in. We haven't seen too much of it back as yet, but hope to see it over the next 3-4 years. So I think over the last 5 years, when we started off to where we are today, I see a great deal of change actually in terms of, one, the maturity of the teams, the maturity of the market per se. The size of the funds has clearly increased. The ticket size of individual transaction has increased. And more importantly, I think there is now an increased understanding both within LPs and GPs in terms of there's no one size fits all, nothing. It's not like everything which succeeds elsewhere is going to work here. When it started off, it was more like this model works there, let's copy it here, and therefore it kind of will get you to the right kind of returns that you want. I think I sense a lot more maturity. People have got to their second funds as well. So when we started off, most of the people were just in their first funds, not too many exits happening. So clearly putting this all together, our sense is there is a fairly exciting time for the venture capital industry. And over the next 5-7 years, we believe this is an asset class which will see much higher growth and much higher interest from the domestic investors.
Yeah, Mihir?
Thank you, Vikram, for this opportunity. So my experience so far has been that the venture capital funds in India, especially the ones which are relevant to us, are the ones who want to court domestic money. And that journey has started a bit later compared to the PE funds. So our experience with the private equity space is a little bit more, let's say about 6 years or so, whereas for the VC funds is closer to 4 years. Because not many funds had the, I would say the inclination to raise money domestically from domestic institutions, because as you know, there are certain regulations which restrict us to funds which can only invest in India domiciled companies and all that things. And plus there was ample money available elsewhere in any case. And a lot of the Indian VC funds are actually offshoots from the global funds, and the global funds never wanted to raise local money. So we got about 4 years of experience, but we have also studied the past of a lot of the funds, and it looks like the vintage of funds which started around 2015, 16, 17, or even 18 has done quite well, because you saw good mark-to-markets and you actually saw a lot of exits in 2021 and maybe some in 22. So that experience has been good. For the cohort of funds which started maybe in 19 or so and were able to do some investments quickly, there are some mark-to-markets. But in the last year or so, I don't think there is any gain in the MTMs of the portfolio. So, and I don't think in the next 1 year or so also we're going to see huge MTM gains. So probably if the MTM does not go up, then we might see a dilution in IRRs, still healthy, but it'll stagnate and the IRR will start reducing a bit. But for our cohort of funds, which we have invested in the last 3 to 4 years, so far things are fine. MTMs are good, so we are kind of sitting pretty, reporting to our investment committees. Experience has been satisfactory, but more importantly, I think the learning experience has been even more fun. Getting to know a whole new space of private investments. We are public institutions, we manage mostly public listed equities and bonds. So to get a peek into this universe has been a good, exciting journey for us. And the returns are also so far so good.
Awesome. Mr. Bharti, actually, both Prasun and Mihir have been investors with us over 2 funds. State Bank has been investor with us over 3 funds. So we'd love to hear your views as well.
PE, VC, or AIF funds, that's treated as a new concept, normally particularly by newspapers and articles. We in SBI treat it as a very old concept. Our first investment in this type of structure or this type of company was almost 70 years back, 1953, if I remember correctly. So it's a development process. Only thing with this type of products is that whether any idea, it can be converted into a business, whether it can get economy of scale, whether it can get funding, required funding at correct point of time, and whether it can reach to the mass who actually need this, who is ready to pay for this. That is the only requirement. For example, 10 years, 15 years back, credit card was a facility. Now, if one person is handling 7 or 8 or 10 credit cards, he wants to know when the repayments are due. Some app is there for that purpose. That's again a new idea. Now, if I am going to buy something, then 5 cards are there, all are offering different type of discount. And now it's more complicated. Tuesday, different discount. Wednesday, different discount. I need an app for that. I cannot go, I am going to buy a kettle, electric kettle of 1,500 rupees. And then I am going to go to search 5, 7 websites to find out where I am getting more discount. Or even if that is costing lakh rupees also. That's not viable. Time is more important. So it's a development process. And I think that if I place this industry or this concept in a human age group, I will say that we are moving somewhere around in 14 to 17 years age. The industry is full of energy. There is potential, huge potential. With every new technology, the requirement and the usage of that technology will increase, and that will further increase the scope of this type of products. So I will place in this stage our role as an LP. We focus on those youngsters who are in correct direction, and if they are deviating, then our role is to give them guidance and mold them to the correct direction. And then there are a few youngsters who will spoil their life, so that's their fate. We have to identify this at correct time. That's my opinion about it.
Sunali, HDFC Bank has started recently investing in VC funds in India. And I think, one unique thing I'm noticing about what you are doing is very actively engaging with VC funds and the portfolio and also the startup ecosystem. So how have you seen the evolution of venture capital funds?
Yeah. So let me start by saying that, look, the venture capital industry in India has really deepened, and so has the startup ecosystem. I walked out of the doors of McKinsey in end of 2015-16. And at that point, I was thinking whether I should actually do a startup, go to the corporate world. I was a junkie, so I landed up in the corporate world. But if I look at the deepening, just the sheer deepening and the growth of Indian venture capitalist funds versus what we saw which is like 7 years ago now, has been phenomenal, right? The rise of unicorns from India itself has been phenomenal. So I think India's market has matured significantly. It's clear that startups and the whole venture capital industry is not a flash in the pan phenomenon, which people thought at some point, in Silicon Valley, there was the 2000 boom, then there was the 2007 boom, then there was the private equity boom in India, which we saw in the early 2000s, to say, is this something that's going to come and, then reach a crescendo and then kind of settle? But I think this is going to be a very big part of India's growth story. I think the kind of energy that is coming, that we are seeing in tier 2, tier 3 cities, the kind of innovation that we are seeing, whether it's defense startups, whether it's startups in the fintech space, or even startups that are actually working on sustainability. I think there's just phenomenal amount of innovation. And the good thing about the startup ecosystem that has now happened is it's no longer about, it's no longer the rah-rah. There's actually focus on profit. It's not just about scale. The investors looking for profit, and I think that is what is going to take the industry forward.
Interesting. Rajesh, you have been a veteran when it comes to dealing with the HNIs and the very large family offices in India. You know, I've seen you for many, many years really helping families allocate their capital across different asset classes. Would love to hear your perspective on how you are seeing, you know, these families and ultra HNIs allocating their capital, how venture capital has evolved and as an asset class amongst those investors.
Really, there's been a lot of learning from both investor and fund managers' point of view. I think from an investor standpoint, it has been about accepting VC as a relevant asset class to diversify beyond public equities and participate in disruptive early stage new age businesses that actually can't be done through listed equity. I think they've also, I've seen, accepted long gestation period, funds of 10 years, because earlier when we used to reckon private equity funds, they were shorter tenors. But we started raising money from HNIs, ultra HNIs in about 2008, with VC funds. And maybe for 3-4 years, we raised money for 1 or 2 funds. But from the last 7-8 years, every year we raise money for 2 venture capital funds. So there's a huge amount of investor interest. They're okay with longer tenors. They're willing to take the risk of liquidity, lock-ins for better returns. And these, we've seen a change that earlier family offices and institutions were the only ones participating. Now, HNIs and ultra HNIs, defined by someone who's got a investable sum of, let's say, 25-30 crores and above, is keen to participate. Some, of course, because of returns, and some have other reasons, more strategic reasons to invest. But I think our role as a wealth manager comes in there in terms of selection of the right VC fund with the right set of managers, doing due diligence, and then recommending. So lots of learning on whom to back, whom not to back, what kind of investors invest. From a fund manager perspective, there's also been, I've seen, increased focus on exits and regular distribution, especially when you're catering to HNI, ultra HNI, and you want to raise further funds. There has been a little bit of focus on seeing whether you could exit your first investment in 4-5 years, you can distribute some money out. Also, concentrating on the right investor profile, the more sophisticated HNIs, ultra HNIs, and not the earlier DCF rules of DCVF rules of 25 lakh commitment, etc. We've also noticed fund managers keeping reserve amounts to prevent risk of getting diluted fast in fast-growing companies, and also spending money in building research and investor servicing capabilities. So that's the evolution from a fund manager side. And then, of course, we have the Mumbai Angels and Let's Venture type of platforms that have created small ticket deals for even affluent segment. Personally, I don't believe, mass affluent segment should invest in venture capital, but you are seeing platforms that have evolved that are also targeting small ticket investments.
Got it. Thank you, Rajesh, for that. The next question, actually, I want to address primarily to maybe Prasun and Sunali, and others are free to answer as well. And I think this is more towards, your active engagement with the startup ecosystem. And I think, of course, what we are also seeing, because we have 70% of our capital is primarily institutional capital. These are all banks, insurance companies who invested in our funds. So we are seeing more and more interest towards, engaging with the underlying portfolio companies, engaging with the overall startup ecosystem. How has been your experience in, dealing through the venture capital funds with the startup ecosystem?
Experience has been very good. I mean, it's a very simple fact, and all of us know it, that no organization, large organization, if it becomes very inward-looking, it's not going to prosper for a long period of time. So we have to look outside. So much stuff is happening outside. It's impossible for any single organization to comprehend what is going on in the world. And as was mentioned earlier, the startup ecosystem is very vibrant, a lot of new ideas. So we have a fairly formal process of actually interacting with the startup world. While there are always startups who approach us in terms of collaborating, figuring out whether they can offer solutions to us, we also have a methodology whereby we really define the use cases we are interested in. And IvyCamp is one of the intermediaries through which we work as well for the same, whereby we put out these use cases in the domain of the startup world, and we get applications from the startups to solve some of these use cases. Over the last 4 or 5 years, some of these use cases have resulted in us being able to get ideas which we would not have got otherwise. So frankly, it's something we believe will continue. It's something which is absolutely essential in today's world, in my view. So therefore, this is something which will continue to be a large part of engagement for us. Apart from that, we obviously will interact with companies which are part of the funds where we are invested in, and see if some of those are useful to us from a business perspective.
So I think on our side, Vikram, we are working with IvyCap and a bunch of other partners. We're actually formalizing a process because as a bank, we have multiple ways we would want to engage with startups. So we are institutionalizing a process for engagement with startups across the country, not just from a use case perspective, but from a much broader perspective. So that one, we're aware what is happening. Two, can this give us a pipeline for kind of investments? So we'll announce that shortly in terms of what is the formal program, but yes, that's happening. In addition to that, we've also done a whole revamp of the product offerings that we have for startups. So we've actually been one of the first banks that's come out with a policy for their startups under the central guarantee scheme for lending to startups. We revamped our complete offering, whether it's insurance or being able to provide support to them for regulatory filings, giving them more access to better offers, which again we're in the process of announcing very shortly. And I think lastly, we've also been very actively engaged in the startup scene for many years. We do the CSR Parivartan Awards that you would have seen a lot about HDFC Bank, where DPIIT startups can actually be eligible for CSR grants. We have a pretty active group of people in the bank that have historically looked at strategic investments for the bank and invested in startups. And we also work with various startups where we offer them banking products, help them understand what are the pain points in various industries, and then together with them actually go and unlock the potential of that industry with technology. So I think we've had a very systematic engagement approach with startups over the years. And over the next couple of years, we only look to make it even more effective because we clearly believe that startups will play an important role in the next wave of growth, and we very much want to be a part of it and have them as our partners on the journey.
Interesting. Mr. Bharti, actually, State Bank of India is, very active now in opening startup branches, right? So you've seen startup branches in Chennai and now in Mumbai, and I think there are 4 or 5 branches which are already there. So how is SBI thinking about engaging with startups?
Our experience is definitely excellent with a startup concept, and as I mentioned, if I praise the non-metric method of Indian age, we are rating startups, this industry, in the age of 14 to 17. So it's our future. Our investment in that side is definitely, the focus is there. We have a very small portfolio. If we consider State Bank of India balance sheet size, our portfolio size is really very small from that angle. We're still moving around $1.2 billion only. But we are looking to double or maybe more than that in next 4 or 5 years. So that clearly shows that this is the focus area, and the startup branch is just with the same purpose, to provide the complete ecosystem for startup companies at that point. And as I mentioned, the startup it's not end of that. It's just a start of that. 20, 25 years back, we have seen these IT developments. Now that IT, the main access of benefit of IT is for a particular country like India with a huge population, that we can reach to a larger base of people easily with less cost. Now, with the facilities will increase, when these people are going to use more and more facilities, the next level of requirement will come. I think we have few startups here also which is providing, for example, egg supplies. Now, if I am getting eggs on my residence daily, after maybe 1 year or 2 years, I will start asking that, okay, I am getting different quality of eggs on daily basis. So whether I can have any app which can tell me that today this particular company is supplying better quality of X or better quality of nariyals, coconuts. Coconuts water, I used to bought them through apps only. Now, sometimes got larger size, sometimes got smaller size. I want a uniform practice. Sometimes I've got green, sometimes I'll get yellow. That can be an idea for some of the people sitting here also. I cannot get a guaranteed quality of coconut from any of the app presently available in the, at least whatever access I have. I want green coconut. I don't like ripe or yellow coconut. That's not available. So this is next level of demand. This demand is going to come. It's just an imagination. That's my requirement. I am not getting. But getting coconut at home, 5 years back or 10 years back, that was not available. If I want to have a coconut, I have to go to shop, maybe 10 minutes or 15 minutes. Now 15 minutes is very costly. I cannot spare 15 minutes for that purpose. I can go for gym for half an hour, but I cannot spare that 15 minutes. That's a different story. But with this facility, the facility reaching to the people, the demand will increase. And obviously, with the demand, the supply will have to increase. If supply is not catching up, then that's the problem. That's why we are finding it as a very young industry.
Interesting. And Mihir, maybe you can answer this in terms of the asset allocation between the public and the private, right? So I think, when you are looking at it as obviously, looking to allocate across different asset classes, how do you decide, how do you really do your allocation across different asset classes?
One is, of course, there is regulatory limits to which you can put money in different asset classes. But in general, it's typically a combination of our own asset liability requirements. So for the longest type of liabilities, we typically invest in government bonds because you don't get corporate bonds or investments for 30, 40 years. And for the yield enhancement of the portfolio, we look at the risk assets like equities, real estate, AIFs, InvITs, REITs, the whole bunch. And of course, those we adjust for risks, not only the return. So risk-adjusted returns is what we look at. And risk is not only in terms of asset class price volatility, but also the liquidity risk. So for assets like AIFs or real estate, which we can own directly, we are willing to compromise on the liquidity because it's a smaller portion of the portfolio, but then we expect higher returns. So while in public equities, we might expect returns of say 12 to 15%, in a PE fund, it will be probably closer to 20 to 25%, and a VC fund, probably 25 plus kind of returns. So those risks we adjust for, in the returns basically.
Got it. Prasun, you want to add to that from your perspective?
No, pretty much similar. So honestly speaking, for us, when we are allocating to AIFs or VC funds in general, I think it's just a comparison with the listed markets. The rest of the asset allocation philosophy is fairly similar in terms of you are driven by your liabilities. Every insurance investor will tell you that first come the liabilities and then come the assets, right? So liabilities drive your choices. And when you come to risk assets, you're choosing between public equities and private equities. And there are three factors, in my view at least, which are at play here when we look to decide. First is obviously the returns. So, and as Mihir said, unless the returns really justify the investment, both from a liquidity perspective, the fact that you're locked in for virtually 10 years, and the higher risk you are taking when you are going in the private markets. So then at least a 5% kind of a net IRR return to me has to really be compensated. So when I say this, gross IRR doesn't really matter to us. What matters to us is the net IRR, post carry, post fees, post everything which comes to me. And therefore, I think that is where we look at these funds. So our endeavor would be, as we keep getting the money back from some of the earlier investments, we'll look what is really delivering that, what is not. So I think that is the first factor. There are two other factors which come into play here. One is in terms of risk diversification. Because if the correlation between the private and the public markets is not exactly close to one, then you obviously get some diversification and you are diversifying the risk. So that is one more thing we look at. And the third thing, at some point of time, it is not very relevant today given some regulatory constraints, will be ability to really co-invest and be able to access parts of the market which we are not able to access when we are sitting and investing in the public markets. Today, that is constrained given some regulations. Hopefully, that will change at some point of time. And we do believe that once that comes through, the co-investment portfolios of most insurance companies will also become reasonably large. So I think these are the few factors.
That's very interesting. Since you talked about co-investments, let me ask Rajesh. Rajesh, I think one thing at least I have experienced over time, especially with the family offices, ultra HNIs, I think co-investments becomes very important part, from their perspective to decide investing in this asset class. So how has been your experience as far as that is concerned?
No, you're right. Especially the large family offices who've got a corpus of, let's say, 500 crore plus as financial investments. Other than the allocation decision between listed equity and private equity, I think a large part of the allocation decision on VC is about co-investing, becoming anchor investors in a fund where they get an opportunity to co-invest. They are also looking at many times, the second generation who's come in wants to do something different or is looking for other business opportunities. So they try and put their sons or daughters as a part of the co-investment committee along with the funds, just to evaluate deals and see at some point if they would like to play a larger role. And along with that, of course, they're always looking for direct deals. So many of these family offices are being approached by entrepreneurs who want to, have someone on board who may have the ability to help them build the business. Well, even VC funds and PE funds do that, but many families are very well connected, or they may have a business interests in that field, and hence they're looking at them adding value, for many of the investments that they make. So family offices are looking at these 2-3 areas, either co-investment. They tend to not cut out small checks, barring some who have, no interest in co-investment, just looking at returns. They may spread their investments right across VC to late stage. But the real big corpus money is looking at co-investment, definitely.
Got it. So, I think State Bank did their first ever co-investment with IvyCap, in biryani by kilo. And after that, I think SBI has made quite a few co-investments. So how's been your experience, Mr. Bharti, as State Bank as an institution, co-investing with funds?
For us, co-investment is I will say that it's a shortcut type of thing. We have a small team, 7-8 people looking in this PE segment, and even with use of technology or whatever, we are still at a stage when we need one-to-one interaction. Before investing in any company or any firm or any fund, we need a one-to-one interaction with the person behind the project, and the team of 7-8 cannot contact thousands of people, even in a duration also. So this co-investment mode provides us an opportunity to reach those companies or those units where we have already some exposure, where we know that what is going on. And that's definitely an easy route. Obviously, that has to be done with the other interested parties also. So we are very, very much interested in that area.
Got it. Sunali, HDFC Bank has now become the 4th largest bank in the world. I think this is a great honor and pride for the country as well, with the Indian bank becoming such large globally. And, with the kind of activity now that you are personally involved, engaging with the startup ecosystem, I think there is that regulatory challenge sometimes which kind of maybe creating certain constraints at certain times in terms of how you operate, working with funds or working with startup ecosystem. So how's been your experience in terms of the regulatory environment, how it has evolved over time?
So I think the regulatory environment has actually just substantially helped banks to support the startup ecosystem. So today as a bank, sub 10%, you can invest without any doubt in any startup that you would like. So I don't think there are any regulatory constraints per se. I think from a fund of funds perspective as well, we've been investing in VC funds. So there is, again, I think from the appetite perspective, we don't see any challenges. In fact, if you ask me, I see we've signed MOUs with various state governments where we're actually working with them to set up, where they're setting up accelerator programs for startups that we have been engaged with. If you look at it, I think right now IBA themselves are kind of working with us. My colleagues from SBI are also part of that working group on how you can actually provide more support to startups by way of credit. The whole central guarantee scheme for startups, which is about, 10 crores is the cap of the scheme, and up to 3 crores you get 80% guarantee, I think is a big step forward as well, right? To be able to encourage, and the requirement is only that the startup should have had 1 year of an audited balance sheet, should have been around for less than 10 years. And of course, the definition of startup is very wide, which I always believe it can be pruned because it gets used for various things. But I think that's a challenge Startup India team and the Invest India people are sorting out. But I think if you look at it, there's so much happening. I mean, whether it's in the area of defense, where we recently signed some MOUs, I just think that it's almost like a red carpet, I think, for startups. So this is a great time to be a part of that industry and, ride the tide.
I know we've run out of time, but, panelists might be around for some time. So thank you so much for everybody's time here. And thank you so much, all the panelists, for your time today. Thanks, Rajesh.